right, we are now recording. I'd like to thank everyone for attending this week's Women in Agriculture Wednesday webinar. Today we'll be talking about crop insurance programs for 2018. Our last webinar of this season of the year is What is Annie's Project? That'll be on December 13th. We'd also like to announce the 2018 Mid-Atlantic Women in Agriculture Conference, as well as the 2018 Annie's Project classes. They've been announced as well. All that information, as well as recordings from today's session and past sessions, are at extension.umd.edu/womeninag. You can go there and find all of our previous webinars and hope to have 2018 webinars announced soon. At this time, we also like to thank our sponsors of the Women in Agriculture program, as well as the collaborators. If you have any questions you can read or comments regarding today's webinar, feel free to put those in the chat pod. And with that, I'm going to be turning the presentation over to Howard Leathers and Paul Goringer.
Good morning. This is Howard Leathers, and my instructions today are to provide an introduction to the topic of crop insurance, what it is and how it works, and then I'll turn things over to Paul.
You have to click on this thing the first time and then it works.
And these are the people who sponsor our efforts here. I am with the Department of Agricultural and Resource Economics here at the University of Maryland. Crop insurance is one tool for helping farmers manage risk. And it won't come as a surprise to anybody to read the assertion that farmers face a lot of uncertainty. Farmers, as they plant their crops in the spring, they don't know whether the price is going to be high or low. They don't know whether the weather will be good or bad. They don't know whether they will face diseases and other natural disasters that can cause problems for their crop. And crop insurance is then a way to get a handle on some management of financial risk as in those circumstances. So just to give you an idea of the magnitude of the risks farmers face, now this is corn price. You can see that over this a little over 10-year period, the peak price is more than twice as high as the bottom price. And likewise, this is showing average corn yields for the state of Maryland. And here again, we see the peak being nearly twice as high as the bottom. In this situation, of course, this is an average among all farmers. So if we had data for an individual farm, we would see significantly more variability for an individual farm than we see for average yields over the whole state. After I present how crop insurance works, I am going to come back to an individual farm example and try to encourage you to think about what risk is for your particular farm. And that will be different from farm to farm, depending on the farm's debt level and off-farm income. And both of those items have been growing. As you can see in past years, agricultural debt is now approaching the levels that it was back in the mid-1980s when there was a widespread farm financial crisis. And over the last 40 or 50 years, we've seen huge increases in the importance of off-farm income to farmers. So now we get into the sort of dull nuts and bolts part of how does crop insurance work. And there are two broad categories of crop insurance: yield insurance and revenue insurance. And I'd like to start then with an example of how yield insurance works. All crop insurance for an individual commodity is based on a farm production history of yields for that commodity. There are, as in much of what I will say today, there are caveats and details and exceptions that I'm glossing over. You should always sit down with a crop insurance agent and check out the details specific to your needs and your farm. But in my example here, I have a farmer who has a history of yields on his particular farm, and in this case, it's an average yield over the past 10 years for a specific crop on a specific farm. And in my example, the average yield for this farm is 150 bushels an acre. The first thing the farmer does then in making a decision about crop insurance, of yield insurance, is to choose a level of coverage. Any number between 50 to 85% in increments of 5 percentage points, that means that the farmer is choosing a level at which he wants to trigger an indemnity payment. So if the farmer, in my example, chooses 75% yield coverage, 75% of his 150 bushels an acre historical yield, 75% of that is 112.5, meaning that the farmer will receive a payment from the insurance company if yield this year drops below that trigger level of 112.5. So we would say the insured yield in this example is 112.5, or that the farmer has purchased a 75% coverage of a yield insurance product. The size of the indemnity payment is related to how far the actual yields fall below the insured level. So we have now in our little example here a farmer who's gone to a crop insurance agent and made the decision to purchase 75% coverage of yield insurance, and that decision is made prior to planting in the very early spring or late winter of the year. Then the crop continues to grow, and by harvest we have an actual yield for the farm. And if it's that actual yield falls below the insured level, the farmer collects an indemnity payment from the insurance company. So in my example, the actual yield of corn is 100 bushels an acre, and that is below the insured level chosen by the farmer of 112.5, and it's short by 12.5 bushels. So it's that 12.5 that's going to determine one element of determining the size of the indemnity check the farmer gets from the insurance company in the face of this especially low yield year. Now you might say, why won't a farmer always just choose the highest level to trigger? Why doesn't every farmer choose 85%? Of course, the answer to that is the higher coverage you have, the higher your premium is. So again, a farmer could choose 85% normal, in which case any yields below 127.5 would trigger an indemnity, or 80%, meaning 120 bushels would trigger, et cetera, all the way down to 50% of normal, which would mean that insurance payment would kick in only if yields fall below 75 bushels an acre. So this explains when an indemnity payment will occur under this kind of insurance, but it doesn't explain how high that indemnity payment will be. So the size of the indemnity payment depends on the expected harvest price at the time of planting. That is to say, when the farmer visits the crop insurance agent and prior to planting and says, I want to buy crop insurance for my corn crop this year, the insurance agent and the farmer will sit down, they will take a look at the futures market to see what the prices are for a post-harvest month. So for corn, they look at the futures prices in the February newspaper for a futures contract that will settle in December of the year after harvest. So in my example, this expected price is $4, and now the farmer has to choose what percentage of that expected price he wants to be compensated for in his indemnity payment. In my example, a farmer chooses a 70% price election. That means that the shortfall, the yield shortfall will be paid at 75% of the $4 expected price, or $2.80. So following through with my example from the last couple slides, the insured yield was 112.50, the actual yield was 100, the yield shortfall was 12.5 bushels an acre. The indemnity price chosen by the farmer is $2.80 an acre, so the indemnity payment will be $2.80 times 12.5, or $35 an acre. If the farmer had insured 100 acres of corn, the size of the indemnity check would be $3,500. Here too, premiums are higher with higher price election levels. So this is the way that yield insurance would work to provide a payment to a farmer in a year when crop yields were exceptionally low. The second general kind of crop insurance that's available is revenue insurance. The difference between revenue insurance and yield insurance is, as we just discussed, for yield insurance, what triggers an indemnity payment is low yields. And for revenue insurance, as you might guess, what triggers an indemnity payment is low revenue. So how do we determine what low revenue is, and how low does it have to be before that payment gets triggered? The first step is to calculate the expected revenue per acre at the time of planting. So the expected revenue at the time of planting equals the expected yield that we get from the average production history on the farm, times the expected price. And there we get a price at harvest at the time of planting. So expected at the time of planting, the price would be at harvest. So again, we use the futures market. The price for September corn futures is $4 in this example. During late March, that means that at the time of planting, the expected price of corn was $4. So we use those numbers then to calculate the expected crop revenue per acre. In my example of 150 bushels an acre and an expected price of $4, the expected revenue is 150 times 4, or $600 an acre. The farmer then chooses a coverage level or an insured level. And in my example, the farmer chooses 75%. 75% of 600 is $450. That is now the level of actual revenue that would trigger an indemnity payment. So if actual revenue per acre falls below $450 in this example, an indemnity payment would be triggered. So let's finish this up with an example where the actual yield on the farm is 130. That is lower than average yield, and the actual harvest price is $3, or quite a bit lower than the expected price at the time of planting. So actual revenue here is $390. That is lower than the trigger level of $450, and it's $60 an acre lower meaning that is the size of the indemnity payment for the farmer. So again, a farmer who had insured 100 acres would get a $6,000 indemnity payment in this example. So I've mentioned several times that, of course, the more expansive the coverage that you choose, the higher your premiums are. One thing, though, that's critically important to understand about these premiums is that they're heavily subsidized by the government. So this just shows that that farmer premiums can be as low as a third of the total premium paid. And these are some historical numbers, but showing that the average premium subsidy has grown over the years. It is now in the range of 60%. And tied with this we've seen a very widespread expansion of the use of crop insurance, now covering about 80% of planted acres. So it is this premium subsidy that really serves as the basis for the underlying argument in favor of crop insurance. So I like to give this example from the auto insurance industry. In a recent year, Maryland drivers paid about $4 billion in premiums to insurance companies for auto insurance, and the insurance companies paid about $2.7 billion for accidents covered under those. So those of us who have auto insurance received on average 64 cents of money back for every dollar we paid into the insurance companies. But when I first put these numbers together, I thought that couldn't possibly be right. And then I started noticing during sporting events how many auto insurance ads there are. So this is where some of that extra money goes, is to buy TV ads. Now let's take a look at similar numbers for crop insurance. Since the year 2000, Maryland farmers have paid $147 million in premiums to crop insurance companies, and those insurance companies have paid back $250 million to Maryland farmers to cover insured losses. So farmers are receiving $1.70 of indemnities for every dollar of premiums paid by farmers. The insurance companies stay in business because they receive additional premium payments from the government. So the final thing I want to do is just walk through an example of how crop insurance can actually lead to material differences in the life of a farm household. So I start with this example, and this is obviously cutting a lot of corners here, where I have a 400-acre grain farm in which they grow corn and soybeans. They have net farm income of $125,000 a year, not including loan payments. They have, in my example, a non-farm income of about $25,000. Their total household income is $150,000 a year, and that goes out the door in these following ways: about $35,000 or $3,000 a month for basic living expenses, food and cable bills and electricity, etc. Then I have another $20,000 budgeted for other living expenses. So that might include a vacation, it might include payments on a second car, or eating out. There are loan payments for the farm loan, which amount to $70,000 a year. And then in my story, I have a child of this farm family who's attending college and needs $20,000 a year for college tuition. The total household costs then come up to $145,000, and we have this little buffer every year of $5,000 a year. Now, what if the corn yields falls to 60% of normal? Revenues are down by $54,000. I have this farm family adapting to that by increasing off-farm work. So the point I'm trying to make here is that as farm revenues or farm yields decline, this makes real differences in the lives of the farm household. So an additional 2 weekends of work, say at an off-farm job, or another member of the family taking on some off-farm employment. I have those other living expenses declining from $20,000 to $1,000. So kiss the vacation goodbye, sell that second car, stop eating out, whatever was going into that. Those are virtually eliminated. The loan payments I have, in this example, maintained. The farm is continuing to make its loan payments, so it's not looking at foreclosure threats or anything. But in order to achieve that, it's had to completely eliminate the tuition assistance for the college student. So either the student stops attending college, or the student takes out student loans or whatever. Savings is now reduced to zero in this example. So let's see. My main point was that this risk, of course, is specific to this farm based on their lifestyle choices and off-farm employment choices, their commitments to help a child in education, their other commitments that they might have made to buy a second car, or et cetera. And that will differ from farm to farm. If we looked at a farm like this that didn't have any loan payments, oh, well, they've got quite a large buffer here. So if you inherited the farm, you have a different situation to look at. Now let's take a look. How does crop insurance help here? The left-hand column is the one that I just talked about. I can see the title of that is wrong. It should say without insurance, but that's the one I just saw with what I'm comparing here is the good year to the bad year. Is what these are. The left-hand side is a good year with corn revenue is still $135,000, and then the right-hand column is with corn yields falling to 60% of their normal, meaning that revenues are down $54,000. Here again, I have the increase in off-farm employment. I have the reduction in other living expenses. But now, because of an indemnity, a $20,000 indemnity payment from crop insurance, I'm able to pretty much continue the support for the college student. So this is intended to be an example of how having crop insurance can actually make a difference in the real-world living situation of a farm household. You notice that the regular year column, of course, we've lost $5,000 of our savings and buffer. That's because you pay that insurance, you pay that crop insurance premium in good years and in bad, and when it does pay an indemnity and when it doesn't. So that's the purpose of risk management, and the way crop insurance works is it brings the high years aren't quite as high, and the low years are not as low. So this is the end of what I wanted to do, introducing crop insurance and explaining how it can make a difference in the real life circumstances of a farm household. And I now turn things over to Paul.
Boy.
I better open the chat box real quick to make sure we didn't have any questions. Okay, we didn't have any questions. I'll go on. So Howard's kind of talked about crop insurance, and I'm going to talk about some various programs that exist either in crop insurance or exist in other sort of like crop insurance. So the first one is the non-insured crop disaster assistance program. This is not crop insurance, but it's available where crop insurance is not available. It's a program run by Farm Service Agency, so you go into the county office and sign up, and we'll talk about that here in a second. But for those that have used it in the past, the 2014 Farm Bill sort of changed some of the coverage options. So prior to 2014, the coverage was just 50% of expected production. So we go back to Howard's examples. You would just get protection on 50%. So it's basically just catastrophic protection. And then basically the 2014 Farm Bill changes to allow these buy-up coverage. So you can buy up in 50 or 5% increments from 50% up to 65%. So we're not going as high as crop insurance, but we're allowing you to buy up some coverage, and we'll talk about how buy-up coverage works. Oh, and I have to use the page down. The other thing associated with this is you have buy-up coverage, but if you just do the 50%, you have what is known as a premium payment that has to be made each time. So you're making either the lesser of $250 per crop or $750 per producer per county with an $1,875 maximum payment that you can be charged. You're charged 5.25% on liability, but for beginning farmers, and I can't see the list of who's all on here. If I scroll down, I can see that, I bet. Oh, I actually can. I now can, and that's going to screw up the thing so I can't see anything. But for any of the beginning farmers out there with less than 10 years production, limited resource, or socially disadvantaged, you get a waiver of this service fee, and you're paying 5% or 50% premium discount. We're going to talk about that here in a second. Go back to this. No, my gifts didn't work, sadly. So with this, there is a payment limitation. If you've dealt with other Farm Service Agency provisions, crop insurance does not have a payment limitation. So if we go back to Howard's example, you can actually go beyond the $225,000 per entity limitation. But with crop or with NAP and coverage, there's a $250,000 per entity payment limitation, but this is separate from other payment limitations that may exist with other programs you're participating in. So if you're in ARC or PLC, this is a separate payment limitation from those two. Page down. So we came up with an example based on some of the examples given by Farm Service Agency. We have 5 acres of peaches. We're making about 181 bushels per acre with the peaches. We have a market price of about $17.75 per bushel. The farmer goes out and buys NAP coverage at the 65% level. So we go ahead and calculate what we would expect to make in a normal year, which is about $16,000. At the 65% coverage level, we're insuring about $10,442 in revenue. Our premium is going to be $540 based on that, plus the $250 per crop service fee. So scroll over to the next deal. So for a socially disadvantaged farmer, how does this change? Well, it's going to reduce by about $505. So in the previous example, if we look back, you're paying $798 for that level of coverage. If you're a beginning socially disadvantaged or limited resource farmer, your premium is going to drop to, there will be no service fee, and you're paying 2.6% on that buy-up coverage. So it works out to $274.62. So there are some advantages to looking at NAP when crop insurance is not available. So how do you go about getting NAP? You go to the local county office and apply before the deadline. We haven't talked about this, but crop insurance has various deadlines depending on the crops. NAP has similar sign-up periods, so you need to sign up typically right after harvest or right after planting. You need to make sure you get your sign-up done in the appropriate amount of time. If you do have a loss, you need to go file notice with a local FSA office that it may be resulting in a NAP payment. Then you apply by the harvest time for the NAP payment and report any crop production on covered commodities each year with your local FSA office. So the next program I want to talk about, now we're back in the crop insurance land. I should have reorganized these slides, but I forgot to do that until right now. Whole farm revenue protection is this new idea that was created again in the 2014 Farm Bill. And the idea was to provide a risk management tool to cover all commodities on a farm with up to $8.5 million in insured revenues. And you have to grow a number of crops to get up to $8.5 million. The idea was this needed to be used by specialty crop growers in diversified operations. We had numerous operations that were diversified enough that they would have to go out and buy multiple policies on various crops. And this was a way just to ensure revenue and take away the ability for them to have to go out and buy multiple policies. They just have to do one policy now. So it's going to protect against the loss of expected farm revenue. Sales closing dates vary. It's typically March 15th for calendar year filers or early filers, so it's all going to depend on how you file your taxes. And if you're a late filer, the rules have recently been changed to give you till November 20th to do that filing. It's designed for, like I said, these diversified crop, mixed grain, organic, and livestock producers. You can again buy coverage up to from 50% to 85%. And this is all going to depend on the level of diversification on your operation. So you need to check with your crop insurance agent to see which ones you're eligible for. So it's going to protect against this expected loss in revenue from either crops produced during the insurance period. So whatever you produce on the farm and you sell during that period, whether it's sold or not, is protected. All commodities you buy for resale during the insurance period. So if you have a farm stand, farmer's market where you're buying product and then reselling it and for some reason can't sell it, it's going to cover that. It's also going to cover if you have to buy it and then the other side's unable to produce it due to drought or disaster. And then it's all commodities grown on the farm, but excluding timber, forest products, animals for show, or pets, and there's one other group of livestock not included in this, which I think is on the next slide. It also excludes revenue from crops grown under contract. So basically, if you're a poultry grower on the Delmarva, all your poultry revenue is going to be excluded from this because looking at how RMA views this, you do not have risk of loss on that revenue. Currently, any non-contract livestock, so if you're doing backyard poultry, small flock, anything where it's not grown under contract is going to be covered under whole farm. So we look at what, to get a covered revenue or covered loss, what your expected payment is going to be. We look at the expected revenue or historic whole farm average revenue. Your expected revenue is calculated on your farm operation report that you file each year. Historic, we're going to look back at 5 consecutive tax years. Schedule F's minus the 1 immediately before the insurance period. So for this year, it would have been 2011 to 2015. The sales closing date is in March, so your taxes typically may not be done at that point. You may still be trying to get them done at that point, so we don't require that, and they've immediately been filed in some cases, so they are not required. For next year, it would be 2012 through 2016. And the losses occur whenever the farm's allowable revenue or the revenue the IRS requires to be reported on your tax records falls below the insured revenue. So whatever you report to IRS, if it falls below what you've historically done and has been insured, that's when you have a payment. So in my example, I have, you have $1 million in insured revenues. You're growing 2 crops, so you're able to cover 75%. During the insurance period, your expected revenue or expected approved revenue is $650,000. So based on this, you would experience protection or a covered loss of $100,000. So we have $1 million times 0.75 minus 650,000 gets us that. So anytime that expected approved revenue falls below what you've insured is when you would get a payout. And one thing I haven't pointed out, I really don't have in the slides, is being able to verify this is one of the issues when we look at this with crop insurance agents. You need to have good record keeping, and on RMA's websites they show you some of the levels of record keeping they're looking for. And the final thing I want to talk about is just organic crop insurance. And this kind of started prior to the 2014 Farm Bill. RMA had been knocked by the federal government, basically through a review of the program, that organic crop insurance did not work well for organic producers. So they started making changes in 2014 to kind of help it work better for organic producers. So the 4 big changes that came about out of this was it allowed organic producers to grow crops under contract, growing crops under contract, to use the contract price as their price election, if authorized on the actuarial tables for the crop in the county. So basically, if you're an organic producer growing a crop under contract in your county and it's allowable, that it becomes your price election that you can use. We don't have to look at what the futures market is reporting in that case. In many cases we were, and producers were taking a price discount instead of actually getting the price premium they would be for growing organics. RMA also began to look at what were the organic crops coming out that needed their own organic price selection. They also established organic transitional yields. So if you don't have yield history, you need a yield. Prior to this, we were using just an average for the county for each crop, but now they're beginning to develop specific organic transitional yields. And no longer charge organic producers a 5% surcharge on their organic crop insurance policy, so they get it at the same level that everybody else does. Like I said earlier, you're now able to use prices established in those contracts as your election price. It actually allows it to be more reflective of their true value. Organic producers will have the option to choose between this or an existing crop insurance price election where that option exists. So you do get an option, whichever one's going to work better for you in that case. Starting this year, there were 56 crops recognized nationally for this organic price election. Premium organic price elections will be available only in certain locations and for certain types of crops given the data and availability. The one thing about this is RMA is venturing into trying to set this up. Everything still has to be actuarially sound since it's an insurance product, so they're trying to make sure they have good data before they actually go out and sort of set these premium organic price elections. In Maryland, where do we have organic price election? It's on apple, barley, corn, corn silage, fresh market sweet corn, fresh market tomatoes, grain sorghum, green peas, wheat, tomatoes, sweet corn, soybeans, processing bean, peaches, potatoes, and oats. This list grows each year. So if your crop is not currently covered by it, it probably will be in the future, just depending on when RMA gets the data to show actuarial soundness on each one of these products. The other thing to point out is with adjusted organic transitional yields, this has been going on since 2014. They have been changed to reflect the true experience with organic farming. Prior to this, they were using just regular production histories. Oh yeah, and prior to that, we will not change those, and you can actually use the production yield histories. Generally, these tables are updated every 3 years to reflect change over time. So again, this is something RMA is slowly changing to make the program more actuarially sound. And I think we're done, and are there any questions? I'm hoping somebody typed some questions in.
Yeah, any questions?
No, we covered it so well, they don't have questions.
So the new Farm Bill is in talks. I take it that'll be crop insurance will be a big discussion on the new Farm Bill.
I would think it would be.
Yes, I think it always is. The crop insurance industry is, of course, very interested in details, the levels of subsidy, the formulas by which administrative costs for crop insurance are determined, and the allowable profit margins that go into the calculation of what actuarially fair means are all things that influence them. So the crop insurance industry is, full steam ahead trying to influence those.
Great. Right. Okay, well, we're going to go ahead. I'll go ahead and stop the recording if there's any other questions.